This is a lecture from Open Tuition. For the free slides that go with this podcast, please visit opentuition.com.
The ACCA's fundamental principles are as follows. First, integrity. Basically, this means that members should be honest and straightforward. If they see something is amiss, they should say so. They shouldn't try to conceal. They shouldn't try to be ambiguous. They should state things plainly. Secondly, objectivity. Members should be influenced by the facts and the facts only. They must avoid bias, conflict of interest, and undue influence. Third, members should exercise professional competence and due care. They must keep themselves up to date with legislation and recent developments. They shouldn't take on work which they are not qualified for or for which they have no skills. They must be diligent. They must be careful. Fourth, confidentiality. Members, particularly perhaps auditors, have access to information which is highly confidential and which is indeed price sensitive. That information must be held confidentially. Members should not disclose confidential information unless they have a legal or professional duty to do so. An example of a legal duty to disclose information can arise if a member thinks that a client or the person they're working for is involved in money laundering. Many countries have very strong regulations nowadays that money laundering suspects should be reported to the authorities. Finally, members should show professional behaviours. They should comply with the law, and they should avoid any action which discredits the profession. So, for example, when they're trying to advertise their services, they shouldn't say that other members are bad or poor. They should confine themselves to promoting what they are good at. They shouldn't rubbish other professionals.
This slide presents a simple list of the potential users of accounting information. It simply emphasizes once again the important role that accountants play in modern economies. Accounting information is usually divided between management accounts and financial accounts. Management accounts are internal. They can be in any format. They look to the future, for example, setting budgets, and back, for example, looking at performance to date. They're often what's known as ad hoc. That means they can contain non-routine special reports. Their form and content is not governed by statute. Management accounts are governed simply by the need for information and how that can be best provided. Finally, they are not subject to audit or independent checking of any sort. Financial accounts are the published accounts of a company, particularly provided for the members or shareholders of the company. Their format and content is tightly regulated by statute. They always look back, what the balance sheet at a particular date was and what the profit and loss account for a period was. They are absolutely routine, normally appearing annually. They must comply with statutory and other accounting rules. And often they are subject to audit, certainly once a company becomes a significant size. We've made several references to the term audit, so let's just cover a little bit more about what that might entail. If you remember back to the problems of corporate governance, these arose from the fact that the owners of the company, the shareholders, appoint directors to run the company on a day-to-day basis. But how do the owners know that the directors are running the company properly? Originally, the only real check was that once a year the directors had to produce a set of accounts. And to ensure that these were what's known as true and fair, independent auditors were then appointed by the members to check those accounts. We talk about accounts, but really we should talk about financial statements. And the financial statements comprise the profit and loss account, or nowadays that will be called the income statement, the balance sheet, probably nowadays called the statement of financial position, the cash flow statement, any supporting notes to these documents, and sometimes a statement of reserves. The external auditors look at these financial statements, do many checks, and come to a conclusion about them. True means that the financial statements are more or less arithmetically accurate. Fair is a slightly more difficult concept and means that they are not misleading, because something can be arithmetically accurate yet still give an incorrect impression. Additionally, what the auditors do when they're examining the system of internal control of the company and what's happened during the year is they produce reports to management about their accounting procedures. So if the auditors find, for example, that invoices are not being priced up properly, they will report this to management, and management can then take action to try to ensure that those errors do not occur again in the future.